Chapter 1. The chips slid across the table and the room stayed steady. That was the part I couldn't shake. A guy to my left had just dropped 3 hands in a row. His face tightened slightly like he was running numbers in his head. Around him, nothing shifted. The dealer's tone stayed the same. The pit boss stood relaxed. The lights hummed overhead without drama. Cards flipped, chips stacked, chips disappeared. The rhythm continued as if nothing significant had happened. The calm felt almost strange. Not cold, not indifferent, just consistent. You could sense the tension in the players, though. Shoulders crept upward, fingers tapped the felt. Small sighs slipped out between forced smiles. Every loss seemed to land on their posture. Every win softened their expression for a few minutes. The table carried emotion. The room itself did not. At one point, a player doubled down aggressively after a string of losses. You could see the story forming in his head. The next hand wasn't just a hand. It was a correction, a restoration, a moment to reset the narrative. When he lost again, the weight in his body told the real story. The dealer kept moving. That image stayed with me long after the night ended, because I recognized something familiar in those players. The forward lean when they were down, the exhale when they were up. The way each outcome shifted their internal state. If you've traded long enough, you've felt that same movement inside yourself. The subtle lean toward a trade that feels important. The tightness when price moves against you. The release when a position closes green as if something returned to balance. The room never needed balance. It operated on repetition, on structure, on volume. Individual hands passed through a larger system that didn't change tone based on recent results. The players focused on outcomes. The room operated through process. When I returned to my charts the following week, that scene replayed quietly in my mind. I began noticing how often my posture shifted with each trade. After losses, there was a slight lean forward. After wins, a relaxation that bordered on overconfidence. Each outcome left a fingerprint. It wasn't reckless behavior, it was subtle. And subtle shifts compound. Most traders don't see themselves as gamblers. They have rules. They've backtested. They understand probability intellectually. Yet if emotional state moves sharply with each trade, the posture at the screen starts to resemble the player more than the room. The distinction lives in reaction. In a casino, a short streak does not rewrite the structure. The payouts remain consistent. The rules hold steady. The rhythm continues. The system trusts volume. At a trading desk, a short streak often influences something. Position size might change. Patience might thin out. Criteria might tighten or loosen. Internal pressure rises even when external rules remain intact. The adjustment might be small, almost invisible. Over time, it shapes results. That shift erodes edge quietly. You've likely had sessions where you started grounded and ended reactive. In the moment, it felt reasonable. Market conditions seemed different. Volatility seemed louder. Later, when looking back, the most significant variable wasn't the chart. It was your internal state. The system in that casino expected variance. The players felt it personally. Resistance to variance creates tension. Tension creates urgency. Urgency narrows perception. Trades begin carrying emotional meaning beyond structure. Randomness starts to feel like commentary. The room never interpreted a short run of losses as failure. It interpreted them as part of distribution. There's something steady about that mindset. It isn't dramatic. It isn't emotional. It is structural. Through that lens, I saw something uncomfortable in my own trading. I wasn't always operating from sequence thinking. I was measuring success trade by trade, session by session. Each result held more emotional weight than it needed to. Measurement shapes behavior. If you've ever felt pressure to recover a red day before shutting down your platform, you've felt that player posture. If you've increased exposure after a win because momentum felt strong, you've felt it. If hesitation crept in after a loss because you wanted to avoid another hit, you've felt it there too. The room doesn't hesitate. The room doesn't accelerate emotionally. The room repeats its structure. If this comparison creates a slight discomfort, sit with it. Many traders refine entries endlessly. They adjust indicators. They optimize risk parameters. Few examine posture at the screen. Pause for a moment and acknowledge whether you've recognized yourself in that forward lean. Awareness begins the shift. The insight from that night didn't transform my trading instantly. It altered the question I asked before each entry. Instead of focusing on whether the next trade would work, I began focusing on whether it aligned with the structure I had already defined. That adjustment seems small. It changes emotional attachment immediately. Operating with a structured mindset centers around consistency of execution. It centers around trusting distribution. Long-term results grow from repetition rather than individual outcomes. You don't need a flawless sequence to build equity over time. You need controlled exposure and behavioral steadiness. The meaning of that table unfolded slowly. Once I saw it clearly, I couldn't ignore it. In the next chapter, we'll look deeper into what separates the room from the player psychologically and why so many traders unknowingly shape their behavior around short-term outcomes rather than long-term structure. Chapter 2. What separates the house from the player shows up in direction of attention. One looks across a long stretch of time before the first card even lands on the table. The other feels the weight of the next flip almost immediately. That difference hides easily inside a single moment. Over weeks and months, it shapes everything. When someone sits down to play a game of chance, knowledge of probability rarely changes how the body reacts. Shoulders tighten after losses. Relief follows wins. Even disciplined players feel the rhythm of outcomes moving through them. They manage it with effort, they breathe through it. Still, each result lands somewhere inside. The room itself never rides that wave. Variance already exists inside its expectations. The swings belong to the design. Nothing about a short sequence surprises it. Cards fall, chips move, the system continues. When you sit down to trade, there's a quiet question underneath the charts. Where is your attention pointed? Toward the next trade, toward the next session, toward the next stretch of outcomes that unfolds over dozens or hundreds of decisions. That orientation lives beneath every rule you've written. For a long time, I believed I operated with a long horizon. I wrote about patience in my journal. I told other traders that consistency required endurance, yet I still checked my account balance at the end of the day, hoping for reassurance. A flat week felt heavier than it should have. Drawdowns carried a sense of interruption, like progress had paused and needed acceleration. Language can sound professional while emotion tells a different story. When attention sits close to the present outcome, losses start feeling like signals that something must be solved immediately. Thoughts begin scanning for explanations. Maybe conditions shifted. Maybe entries need adjustment. Maybe confidence slipped somewhere. The mind searches quickly because discomfort wants resolution. A system built around structure moves differently. It holds space for uncomfortable sequences without rushing toward interpretation. Absorption becomes part of stability. I tested this honestly during one stretch of trading that felt frustratingly inconsistent. I decided to measure success through one lens for an entire month. Structural consistency. Every trade followed predefined risk. Every entry matched criteria. Journaling focused on execution rather than outcome. The first week felt strange, almost like ignoring something important. Profit and loss still existed on the screen, yet they stopped being the center of evaluation. I watched whether decisions aligned with preparation. Gradually, something settled. Individual outcomes carried less emotional gravity. I began thinking in clusters of trades instead of isolated moments. 2 losses passed without urgency creeping in. 2 wins didn't create excitement that leaked into the next decision. The sequence felt smoother simply because reactions stopped stacking on top of each other. That period exposed how deeply short-term orientation had shaped my habits before. Small emotional shifts had always followed sequences. A pair of losses tightened my posture. A streak of wins loosened it. Neither reaction felt dramatic at the time. Both quietly influenced execution. The room doesn't reinterpret itself after a handful of hands. Markets change, conditions evolve, adaptation remains necessary. Planning for those shifts happens through review and preparation, rather than emotional momentum during live execution. Thoughtful adjustments come from observation across meaningful data, rather than discomfort inside a single session. Operating with long orientation means defining structure ahead of time. Risk parameters exist before the trade. Criteria exist before price moves. Expectations account for uneven stretches. Variance unfolds without constant rewriting of rules midstream. Think about your most recent drawdown for a moment. Look beyond the numbers. Notice behavior during that period. Did patience narrow slightly? Did size fluctuate? Did attention move toward faster reassurance? Those details reveal orientation more clearly than performance statistics ever will. A person focused closely on the present moment feels pressure to improve the immediate result. Someone focused across a broader arc refines the system itself. That difference creates a quieter kind of confidence. Sitting down to trade begins to feel steady rather than urgent. Nothing needs to happen today for the structure to remain valid. Repetition carries weight. Each decision becomes one part of a larger sequence already accepted. Performance still matters. Context simply expands around it. If this idea connects with your own experience, leave a comment after the video with a single word describing how you usually feel after 2 losses in a row. The honest answer says more about orientation than any chart review ever could. Impatience tends to appear when attention sits too close to the present outcome. The body wants movement. Trades start feeling necessary rather than optional. Decisions tighten. Edge slowly erodes through subtle distortion. Realizing how often my attention stayed trapped in short windows changed how I approached the screen. I stopped trying to solve discomfort immediately. I focused on maintaining steadiness through sequences instead. Posture shifted quietly. Trading began to feel less like a reaction to recent outcomes and more like participation inside a distribution already understood ahead of time. In the next chapter, we'll move deeper into how that orientation becomes practical inside daily behavior, and how designing decisions around distribution changes the rhythm of execution across long stretches of trading. Chapter 3. There's something deeply uncomfortable about realizing you might not fully trust your edge across time. Most traders would never phrase it that way. They talk about backtests. They talk about probabilities. They talk about confidence in their setup. On the surface, it sounds solid. Yet during a drawdown, subtle shifts begin to appear. Size changes slightly. Patience shortens. Criteria tighten or loosen in small ways. The reaction reveals what belief alone tries to hide. Trust in distribution shows itself through steadiness. When trust is present, a short sequence of losses feels contained inside a larger expectation. The mind stays anchored to the broader sample. When trust is thin, even slightly, the present moment expands and fills the entire field of vision. 2 or 3 red trades begin to carry weight beyond their actual impact. In that space, thoughts start forming quietly. This shouldn't be happening. Maybe conditions shifted. Maybe something needs adjustment. Maybe a tweak would smooth this out. The dialogue feels analytical. It often sounds rational. Beneath it, there's usually discomfort searching for relief. I remember telling myself I was simply refining my approach during those periods. I would adjust size mid-streak and label it prudence. I would double-check criteria and call it discipline. Looking back honestly, much of it came from tension in my nervous system rather than signals in the data. The feeling arrived first, the explanation followed. Trust across time creates a different internal rhythm. Decisions remain anchored to the predefined structure that already accounted for uneven stretches. The edge was built with variance included. Losing sequences were never surprises on paper. They only felt surprising emotionally. Volume plays a larger role in psychology than most traders expect. It's easy to say a system has an edge after backtesting. It's harder to live through 20 trades that don't feel aligned with your hopes. Many people evaluate performance inside windows that are too small to reflect the true distribution. Days and weeks begin to define identity. 3 trades begin to define confidence. Expand the window and posture changes. Think in blocks of 50 or 100 trades. Think in quarters instead of sessions. Red days shift into data points inside a longer arc. The urge to repair today fades when attention moves to the sequence. That perspective requires something uncomfortable. It requires allowing today to remain unresolved. The account might close slightly negative. The week might feel slow. Emotional reassurance doesn't always arrive on schedule. Staying grounded anyway strengthens trust in a way quick relief never could. There was a stretch where I intentionally stopped checking my daily profit and loss after every trade. I still journaled. I still tracked execution. I simply removed the constant glance at the running total. At first, it felt strange, almost irresponsible. I had grown used to measuring progress continuously. Without that steady feedback, the day felt quieter. Over time, something settled. My decisions carried less urgency. I wasn't trading to influence the number on the screen. I was trading to follow the plan I had already defined. The absence of constant measurement softened emotional spikes. Wins felt smaller, losses felt smaller. Execution felt more consistent. How often you measure performance shapes how often you react to it. Frequent emotional measurement produces frequent emotional adjustment. Broader evaluation reduces that reflex. When performance is assessed over meaningful samples, individual trades lose their ability to distort behavior. Look back at your own recent streaks. Notice how quickly confidence rises after a couple of wins. Notice how quickly doubt creeps in after a few losses. Those movements happen internally before they show up in statistics. They reflect evaluation windows that are too tight. Designing behavior around distribution changes the questions you ask yourself. Attention moves from immediate payoff to sustained execution. Instead of seeking reassurance from the next trade, you begin focusing on maintaining consistency across a larger sample. That shift softens emotional turbulence naturally. Steadiness builds quietly. It doesn't create dramatic feelings in the moment. It shows up in smaller deviations, fewer impulse adjustments, fewer emotional escalations, fewer decisions made under tension. If you're noticing how often short streaks have influenced your posture, let that observation sit without judgment. Awareness itself begins reshaping future behavior. The more clearly you see the pattern, the less power it holds. Trust across time grows through repetition. Each sequence endured without structural deviation strengthens it. Each drawdown navigated with consistent execution reinforces it. Gradually, confidence becomes less dependent on recent outcomes and more connected to long-term alignment. When the expectation shifts from the next trade to the unfolding sequence, something subtle happens inside the body. The shoulders relax slightly. Breathing steadies. There's less leaning forward, less bracing. The trade becomes one event within a larger framework rather than a referendum on competence. That relaxation doesn't remove seriousness, it creates alignment. Alignment with distribution reduces fear because fear often grows from narrow focus. Widen the frame, and fear loses intensity. In the next chapter, we'll explore how this broader trust allows profitability to emerge even during periods where accuracy fluctuates, and why consistency across sequences carries more weight than individual moments ever will. Chapter 4. What most people overlook about the house is how small the advantage actually is. Casinos don't operate with overwhelming certainty. The margin is often narrow. Sometimes it's only a few percentage points spread across thousands of hands. Nothing about it feels dramatic in a single moment. Yet across repetition, that small tilt compounds into inevitability. Trading edges often function the same way. The advantage rarely announces itself loudly inside one trade. It emerges gradually across sequences. Many traders struggle with this reality because individual outcomes feel larger than they truly are. A single stop loss carries emotional weight. A sudden reversal feels personal. The mind instinctively zooms into the immediate experience rather than the broader distribution unfolding around it. Accuracy becomes emotionally charged in that environment. When a trade fails, the instinct is to search for meaning immediately. Something must have been missed. Something must require adjustment. The brain wants explanation because explanation restores comfort. The market, however, continues moving without offering reassurance. Expecting uneven sequences changes how those moments land internally. Losses arrive as part of the terrain rather than interruptions to it. Clusters appear from time to time. A few stops in a row no longer feel like an anomaly demanding correction. They feel familiar, already accounted for long before the sequence began. There's a quiet strength in pre-acceptance. When losing streaks exist inside expectation, the emotional shock fades. The nervous system doesn't tighten as sharply. Decisions remain closer to baseline. The next setup carries the same weight as the previous one instead of inheriting tension from it. I had to learn this slowly. Early on, I spent enormous energy refining entries. I believed sharper timing would reduce discomfort. Every avoided loss felt like progress. Every unnecessary stop felt like evidence that improvement was still incomplete. Over time, I noticed something unsettling. Even when accuracy improved slightly, my results still fluctuated. Emotional reactions were shaping execution more than entry quality ever could. The real shift began when I changed how I categorized losing trades. After each one, I asked a simple question. Did this align with the structure I defined beforehand? When the answer was yes, the trade joined the record as part of the distribution. When the answer was no, it became feedback about behavior rather than prediction. That separation created clarity. Ego slowly stepped away from accuracy. Losing trades stopped carrying commentary about competence. They became information about alignment. Once that distinction settled in, execution changed in ways I didn't expect. Closing trades felt cleaner. Re-entering later setups felt natural instead of hesitant. Winners had more room to develop because I wasn't rushing to secure emotional relief. Decisions stopped carrying leftover tension from previous outcomes. Consistency and participation began to matter more than isolated wins. Showing up for valid setups repeatedly allowed the edge to express itself. The structure finally had room to breathe. Many traders unknowingly interfere with their own distribution. Hesitation appears after losses. Confidence expands after streaks. Criteria stretch slightly when boredom arrives. Each adjustment feels justified in isolation. Across time, those small changes reshape results more than strategy ever does. Interference rarely looks dramatic. It hides in subtle behaviors. Checking charts repeatedly after a stop loss. Skimming through confirmations, searching for certainty. Increasing size during moments of confidence. Skirting patience when the week feels slow. None of these decisions appear reckless on their own. Together, they distort the edge. Reducing interference creates space for probability to unfold naturally. Participation becomes steady. Emotional spikes soften. The process begins to feel rhythmic instead of reactive. Something else emerges during this shift. Being wrong loses urgency. A losing trade closes and the mind moves forward without lingering argument. There's less bracing before entries, less need for immediate redemption. The chart becomes quieter internally even when volatility increases externally. This steadiness allows profitability to develop in ways that surprise people. A trader can be inaccurate more often than expected, and still progress when risk and reward remain aligned. Small losses remain contained. Larger winners carry weight. Over time, the math expresses itself clearly. That outcome depends on allowing the system to operate uninterrupted. Probability unfolds through repetition. Each trade contributes a small piece to the larger picture. The process resembles compounding interest more than dramatic breakthroughs. Emotional bandwidth expands during this stage. Sessions feel less exhausting. Attention stays available for observation instead of recovery. Decisions come from clarity rather than urgency. The difference shows up quietly in longevity. Weeks pass without emotional swings dominating performance. Months accumulate with fewer disruptive periods. Many traders spend years pursuing sharper prediction. Refinement has value, yet stability often produces deeper impact. Stable execution allows small advantages to accumulate without friction. The equity curve reflects that calm persistence gradually. As comfort with being wrong grows, something softens internally. Losses close without lingering tension. Wins arrive without inflation. Each outcome becomes one event inside a structured sequence. That stability supports endurance. Markets change. Conditions rotate. Volatility expands and contracts. A steady internal baseline allows adaptation without panic or excitement, overwhelming judgment. In the final chapter, we'll bring these ideas together in a grounded way. We'll look at what it actually feels like to sit down tomorrow and operate from this orientation consistently, and why many traders drift away from it even after experiencing its benefits. Chapter 5. Tomorrow, when you sit down to trade, the platform will open exactly the way it always does. Charts will load. Price will move. Candles will form and disappear with the same rhythm they had yesterday and the week before. Nothing external announces that anything has changed. The shift happens quietly before the first order is ever placed. It shows up in posture. You sit down without carrying unfinished conversations from the previous session. The first setup appears and there's space around it. Your breathing stays even. The account balance doesn't feel like a scoreboard demanding immediate adjustment. The session begins as a continuation of a longer sequence, rather than a fresh attempt to prove something. That difference feels subtle at first, almost invisible. Many traders overlook it because there's no adrenaline attached to it. There's no dramatic surge of confidence or urgency. Execution feels steady. Decisions arrive without negotiation. The temptation to measure the day early still appears from time to time. A green trade invites optimism. A red one invites evaluation. Awareness catches those impulses as they arise. They pass without steering behavior. The structure you already defined remains intact. Trust develops gradually in that environment. It grows through repetition rather than emotion. You begin to recognize that the edge expresses itself through consistency of participation. Each trade becomes one entry inside a much larger archive of decisions. Moments arrive where patience feels tested. 3 losses in a row. A slow week. A session where nothing aligns for hours. The market continues moving whether you participate or not. Screenshots appear online showing rapid gains from other traders. Comparison quietly knocks at the door. This is where posture matters most. You notice the urge for reassurance, the desire for confirmation that progress is happening. Instead of reacting immediately, you observe the feeling. Awareness creates distance. The platform remains open. The criteria remain the same. Execution continues within defined boundaries. Many reversions happen during moments like this. Knowledge rarely disappears, plans remain written. The shift happens internally when feedback feels necessary right now, rather than over time. Human psychology naturally seeks signals that things are working. Trading stretches those signals across longer horizons. Operating with structural orientation changes how time feels inside a session. Hours without trades feel calm rather than empty. A flat week feels informational rather than threatening. Results begin to live inside longer arcs. Performance becomes something observed across sequences rather than judged inside moments. Process protection becomes a daily habit. Journaling after trades reinforces continuity. Risk remains consistent even when confidence rises. Criteria stay recognizable even during discomfort. None of this feels dramatic while it's happening. The power appears through accumulation. Losses still occur. Markets rotate through phases. Some weeks carry friction. Some stretches feel unusually slow. The urge to intervene shows up occasionally. You recognize it faster each time. Recognition alone interrupts many reactions before they fully form. That awareness builds emotional stamina. Emotional stamina is difficult to measure directly. It appears through endurance. You stay aligned during drawdowns without internal chaos. Boredom stops pulling you toward unnecessary trades. Strong winning periods pass without expanding exposure impulsively. The nervous system learns stability through repetition. Over time, trading sessions begin to feel procedural in a grounding way. You arrive, you observe, you execute when alignment appears, you step away when it doesn't. Energy remains available for decision-making instead of recovery. Many traders discover that most damage never came from individual losing trades. It emerged from the response afterward. Attempts to accelerate recovery, adjustments made during discomfort, small deviations repeated until they reshaped outcomes. As reactions soften, those cascades become rare. Winning develops differently in this environment. Progress feels gradual. The equity curve begins smoothing without dramatic spikes demanding attention. Profit shows up through preservation as much as participation. Capital remains available because behavior remains stable. There's also a surprising sense of relief that arrives quietly. Trading stops feeling like a series of emotional tests. You no longer sit down needing the market to cooperate with a personal timeline. Each session contributes to a longer body of work. If this conversation has shifted how you see your own posture in the market, share it with someone who spends a lot of energy discussing prediction and accuracy. Sometimes a different perspective opens doors faster than additional tactics ever could. Identity plays a larger role than most people expect. The mindset you carry into tomorrow's session determines how you interpret outcomes long before the chart moves. Some traders sit down hoping for immediate confirmation. Others sit down ready to execute within structure, regardless of how the first trade resolves. That decision never appears on the chart itself. It appears through reaction. Reactions repeated across weeks shape habits. Habits repeated across months shape performance. Performance repeated across years shapes careers. Trading with structural patience allows the edge to unfold naturally. Variance continues doing what variance does. Some sequences run smoothly, others carry friction. The structure remains steady through both. The house never depends on a single hand to define the outcome of the night. It maintains rhythm long enough for probability to express itself fully. Sit down tomorrow with that rhythm in mind. Execute what you prepared. Let each trade stand as one event inside a larger pattern. Over time, consistency stops feeling fragile. It starts feeling familiar.